All right, guys, welcome back to another video. In this video, we're going to talk about how to actually construct a portfolio. Now, a lot of people have questions about this because there's so many options out there. How do I even begin to kind of put an investment portfolio together? And so what we're going to start is with some basic principles and some theory called modern portfolio theory and understanding how risk and return play together. Now, when you're looking at investing, we've talked about this before, it's about a risk return ratio, and you want the highest amount of return for the least amount of risk possible. Okay. The ideal investment is one that has highest return potential and the lowest risk. Now, like we've talked about, that generally speaking, as you increase the risk, you increase the return potential, but increase the loss potential as well. As you decrease risk, right? That range that we talked about, higher risk, the range gets bigger, lower risk gets smaller. So within any specific amount of risk, you want to pick the investment that actually has the highest return potential for that amount of risk, per unit of risk. So that's where modern portfolio theory comes from and is the basis for a lot of the portfolios and how usually investment managers and investment advisors manage these types of accounts. So there's a really great article here on Fidelity's website that kind of shows you how they have this mix. The idea here is all based around the fact that you can combine different types of investments. So you can diversify out, right? Have different types of investments that have different risk return profiles and also kind of counterweight each other. And overall, if you have investments, a kind of a pool of investments that counterweight each other. So when one is going up, the other one has an inverse correlation. The other one goes down. If the other one is going up, the other one goes down. Right? So if the market's declining here, this one actually performs better. If the market's declining for this thing, then this asset actually improves. So it's saying that if you diversify appropriately, you actually will get better returns overall instead of just going straight up risk, high risk in a single asset class. So it's all about building a diversified portfolio. And that's what this is. So everybody's a little bit different, but here's some baselines. So if we look at the risk level, okay, this is made up of US stock, foreign stock, bonds, and short-term investments. That's basically cash or really short duration bonds. So these two are aggressive. These two are conservative, okay? Higher risk, lower risk. So in a conservative portfolio, as you can see here, 30% is in short term, essentially cash or very short duration bonds, and then bonds make up 50. So 80% conservative portfolio, and only 20% in stock. Average annual return here, 5.96%. Okay, the worst 12 months was negative 17. The best 12-month return was 31%. The worst 20-year return, annualized return, was 2.92. The best 20-year average annual return, so over a 20-year span, was 11%. And historic volatility, 4.49. Okay, so that's a very conservative portfolio. So you move up a little bit. It's a balanced portfolio, right? You can see aggressive, you can see it's basically a 50-50 split. So we've got 35% in US stock, 15% in foreign. Foreign stock, generally speaking, is more volatile than US stock. Okay, there's a lot of other factors that influence companies that are located in other countries, especially depending on where they are. So that's considered a riskier type of stock than US stock. So that's why it's less, but 50% here and then about 50% between bonds and cash. Okay, annual return, average, 7.8. Okay, it does better by 2.2%. The worst 12-month return was negative 40%. That's a huge difference. The best 12-month return was 76. Worst average annual over 20 years was 3. The best was 13, and historic volatility is 9.5. Growth, you can see this is shifting a lot more. So it's generally speaking about 70% stocks, 30% bonds and cash is considered a growth portfolio. And you can see it here. So 9% average return, average annual return, negative 52% is the worst 12-month period. 109% is the best 12-month return. So you see these ranges just keep getting wider. I just want to emphasize that. The ranges get wider, okay? So overall, the best period, best average annual over 20 years is 15. The worst was 3.1. And then historic volatility, 13%. And then aggressive growth, obviously, is this. Now, I still think personally, this is a little bit conservative. You know, in my opinion, aggressive growth is no bonds and cash, but 85% stock, 15% bonds, cash. That's aggressive growth. Okay, that's kind of an acceptable standard. Average annual return, 9.7. Worst 12-month return, negative 60. Best 12-month return, positive 136. The range got wider, right? Worst 20-year period, best 20-year period, and historic volatility. Okay. So, we don't have to get into the fundamentals of how to like calculate the risk, but essentially these are standard deviations. And the standard deviation for a more risky portfolio, right? The range is higher. So the standard deviation just gets bigger, which means the likelihood of losing money is higher. The likelihood of earning money is higher as well. So overall, this has a higher average annualized return, right? 9.7. But in between, you are going to get wide variation in returns. You could have negative 60 one year. You could have a positive 136 the next year. Wide variation here, much less so, but you're settling for lower. Okay. So that's kind of modern portfolio theory and saying, hey, when stocks go up, there's an inverse relationship, generally speaking, between stocks and bonds. That's why they're fundamental in all of these portfolios. When the stock market is growing, the economy is growing, people want growth. So they shift assets into growth assets because they don't want to miss out on the growth, which means that stock prices and values increase. When they're doing that, they're moving money away from bonds and putting them into stocks. So bond values decrease. When the stock market is starting to go down, it's called flee to safety. People in growth assets start losing a lot of money, like, oh no, I got to get out. They flee to safety of more conservative assets like bonds. And so the prices of bonds increase. Okay, so there is an inverse relationship between stocks and bonds. It's not always negative or not always an inverse relationship. Sometimes they correlate, which makes things even harder. But generally speaking, that's how they counterweight each other. Okay, and if stocks are losing a lot, bonds are staying up. Okay, so that wraps up this conversation on modern portfolio theory. I'm going to talk more about how you can create this type of portfolio on your own, very easy. And then also talk about over the long term and any type of risk as we're thinking, hey, I'm investing for 20 or 30 years. Should I have bonds? Should I not have bonds? What am I comfortable with as far as risk goes? So we will address that in the next video. All right, see you soon.
If this helped you out, let me know in the comments.